Hi, Gary DeWaal here, and this is Bridging the Week for June 2nd to 6th, and today is June 9th, 2014. Good morning. Both the chairs of the U.S. Securities and Exchange Commission and the U.K. Financial Conduct Authority discussed market structure and low latency trading before the same conference audience in New York City last week, while the U.S. Commodity Futures Trading Commission in Washington, D.C. sponsored a public discussion on the same topic. Meanwhile, at the CFTC, a new chairman began his term on Thursday. We have a lot to cover, so let's begin. Two important international regulators provided different perspectives on low-latency trading last week before the 2014 Sandler O'Neill Global Exchange and Brokerage Conference in New York City. Although Mary Jo White, chair of the U.S. Securities and Exchange Commission, conceded during her presentation on June 5th that U.S. equity markets today are, quote-unquote, not fundamentally broken, let alone rigged, she said the Commission is embarked on a number of initiatives to address issues raised by low-latency trading and market fragmentation. On the prior day, June 4th, Martin Wheatley, Chief Executive Officer of the UK Financial Conduct Authority, struck a more measured tone, stressing the importance to, quote, reflect on automated trading coolly and not get carried away by headlines, end of quote. In her presentation, Ms. White acknowledged that empirical evidence demonstrates that, quote, investors are doing better in today's algorithmic marketplace than they did in the old manual markets, end of quote. However, said Ms. White, market structure rules and practices were principally developed to accommodate manual markets, quote, cannot be expected to optimally address all of today's practices, end of quote. As a result, Ms. White revealed a number of initiatives the SEC and the industry have adopted or are considering to adopt to address various contemporary equity markets issues. These include implementing limit up, limit down rules and circuit breakers to militate against excessive market-wide volatility. Although Ms. White did not identify any specific abuses attributable to low-latency traders, she indicated the SEC is looking at trading practices that, quote, may be working against investors rather than for them. Specifically, the chair indicated she has directed SEC staff to develop an anti-disruptive trading rule, as well as recommendations to enhance, quote, firms' risk management of trading algorithms and to enhance regulatory oversight over their use, end of quote. She also suggested that trading speed may have, quote, passed the point of diminishing returns, end of quote, and that she is considering measures to slow trading down. The prior day, Mr. Wheatley also discussed issues that arise from high-frequency trading. However, he called for a measure review of low-latency trading, which he said, quote, I'm not sure has yet been honestly assessed by all players, end of quote. He also pointed out that issues may not be the same from jurisdiction to jurisdiction and argued against a one-size-fits-all regulatory response. That being said, he pointed out how the European Securities and Markets Authority already has, quote, detailed expectations around systems and controls for both trading venues as well as firms using these techniques, end of quote. He also noted that when MiFID II and MiFIR are rolled out in Europe in 2016, there will be new requirements for low-latency trading. On June 3rd, the same day that a spirited discussion was held at the Technology Advisory Committee of the Commodity Futures Trading Commission regarding low-latency trading and market structure, the U.S. Senate confirmed the appointment of 3 new commissioners to the agency, including its new chair, Timothy G. Massad. He began his tenure at the commission on June 5th. The Senate also confirmed 2 commissioners, Sharon Bowen and J. Christopher Giancarlo, who are expected to join the commission within the next 2 weeks. The Technology Advisory Committee, chaired by Commissioner Scott O'Malia, held sessions on developing a 21st century surveillance program and increasing buy-side participation on swap execution facilities, in addition to exploring the impact of low-latency trading on derivatives market. I have an article on this tack on my website with lots of details. Check it out. The CFTC extended until December 31st of this year the date by when non-US based swap dealers registered with the CFTC must begin to comply with certain transaction-level requirements in connection with swaps arranged, negotiated, or executed by U.S.-based personnel or agents. This relief initially was granted on November 14, 2013, and only applies when swaps are entered into between such non-U.S. based swap dealers and non-U.S. counterparties. The Financial Industry Regulatory Authority filed cases against 4 broker-dealers and settled with 3 for allegedly not providing to the SEC, FINRA, and other regulators complete and accurate information about certain trades arranged by the firms and their clients. The information is commonly known as blue sheet data. The 3 firms settling their charges by each paying fines of $1 million were Barclays Capital Inc., Goldman Sachs & Co., and Merrill Lynch Pierce Fenner & Smith. The firm not settling at this time was Wedbush Securities. A federal appeals court in New York reversed a district court's refusal to approve a 2011 settlement agreement entered into between the SEC and Citigroup Global Markets Inc. The settlement came about in response to the SEC's complaint that Citigroup had, quote, negligently misrepresented its role and economic interest in structuring and marketing a billion-dollar fund, end of quote, where the fund's assets were mostly secured by subprime securities tied to the then-faltering U.S. housing market. The SEC charged Wedbush Securities, a broker-dealer, along with Jeffrey Bell, an executive vice president, and Christina Philhart, a senior vice president, with violating the Commission's market access rule, so-called Regulation MAR, from July 2011 to at least January 2013. This rule, which mostly became effective on July 14, 2011, requires broker-dealers to ensure that all trades that pass through their connections with exchanges and other trading venues to be subject to certain risk filters to help avoid manipulative conduct. And finally, LiquidNet Inc. agreed to pay a fine of $2 million to settle SEC charges that it failed to safeguard its subscribers' confidential trading information between 2009 and 2012. During that time, the company maintained 2 alternative trading systems, commonly known as dark pools. According to the Commission, the firm shared information regarding its customers' intentions to buy or sell securities with corporate issuers, controlled persons of these issuers, as well as private equity and venture capital firms, contrary to an SEC rule requiring that ATS subscribers' confidential information to be protected. Well, that's it for this week's Bridging the Week. As always, there's more information in each article and more articles on the article version of Bridging the Week on my website. Check it out. Until next week, have a great week, and ciao!